Have you ever wondered how a small investment can turn into a multi-billion empire? Our story begins with VG Siddhartha, a man with a rich family history in coffee cultivation. Born into a lineage that spanned over a century and a half of coffee growers, Siddhartha had ambitions that reached beyond the family business. As a young man, he dreamt of serving in the Indian Army, but destiny had other plans. Instead, he found himself immersed in the bustling world of stock market trading in Mumbai. At GM Financial, Siddhartha gained invaluable insights into the financial sphere, shaping his future ventures. With the support of his father, he established Sivan Securities, marking his first foray into entrepreneurship. Using his initial funds strategically, he diversified his investments to mitigate risks, with one part going into his trading business and the remainder serving as a safety net. But VG Siddhartha's vision didn't stop at stock trading. He was always on the lookout for the next big opportunity. Recognizing the potential of the Indian economy's liberalization, Siddhartha made a strategic move into coffee trading. He understood the volatile nature of the international coffee market and decided to establish his own brand, Coffee Day. This move allowed him to have a firm grip on pricing and market stability, effectively insulating his business from the unpredictable swings of the global market. But Siddhartha's vision extended far beyond coffee. He strategically diversified his ventures into various sectors. He entered the financial advisory world with Way to Wealth and made significant strides in real estate by developing the sprawling global village tech park. His footprint even extended into the healthcare sector with the establishment of hospitals, and he unveiled luxurious resorts in exotic locations. Siddhartha's approach to business was not just about expansion. He was creating an ecosystem, a network of interrelated businesses that could support and nourish each other. Siddhartha's ventures were not just about expansion, but also about creating an ecosystem that could sustain itself. Siddhartha's acumen wasn't restricted to his own ventures. He was a master at making smart investment decisions. One of his most notable financial moves was participating in the initial public offering of Mindtree. This strategic decision paid off handsomely, bringing him substantial returns and contributing significantly to his growing wealth. But Siddhartha's financial prowess wasn't just about making the right investment. It was also about timing and recognizing the potential in the market when others couldn't. His initial investment, a modest sum of 7.5 lakh rupees, was not just money. It was a seed that he planted, nurtured, and watched grow into a vast empire. By 2015, this empire was valued at an astonishing 6,000 crore rupees. That's the power of strategic, well-timed investments. VG Siddhartha's entrepreneurial journey is a testament to his exceptional vision, business acumen, and astute investment decisions, a vivid example of how a small investment can indeed turn into a multi-billion. Ever wondered about the challenges brewing in the coffee industry today? Particularly, how is Coffee Day Enterprises Limited, a major player, coping? We're diving into a deep analysis of this company's performance, where it's not all smooth sipping. Sure, they've seen a rise in net sales and net margin, a positive sign, but there's a bitter aftertaste. They're grappling with important issues like profitability, stability, and valuation. So it's clear that Coffee Day Enterprises Limited needs a strategic shift to tackle these issues and ensure future growth. But first, let's delve into the current challenges the company faces. Coffee Day Enterprises Limited has been grappling with an unsatisfactory TSR value and profitability indices. This financial predicament is further complicated by negative net profits recorded in recent years. Moreover, the company has been showing inconsistent performance in valuation ratios and a declining book value, which may hint at potential undervaluation and strategic misalignment. These factors point to a need for strategic realignment and a reassessment of the company's financial health. Now, how can Coffee Day Enterprises Limited address these concerns? Here are some strategies. First, they should focus on enhancing operational efficiency. Streamlining processes, optimizing the supply chain, and enhancing distribution channels can reduce costs and boost profitability. Second, a strategic debt management plan is critical given the company's high debt-to-equity ratio. Renegotiating debt terms, exploring refinancing options, and diversifying funding sources can improve financial stability. Third, to increase market share, they should consider expanding their product portfolio and venturing into new markets. This can create new revenue streams and mitigate risks associated with a single product focus. Fourth, a customer-centric approach is vital. Investing in CRM systems, identifying evolving consumer trends, and revamping marketing strategies can enhance brand perception and customer loyalty. Lastly, embracing technology and innovation can improve their competitive edge. Advanced coffee-making technologies, sustainable practices, and digital platforms for marketing and sales can lead to greater efficiency and engagement. These strategies, if implemented effectively, could put Coffee Day Enterprises Limited on the path to sustainable growth and success. In conclusion, a strategic overhaul is crucial for Coffee Day Enterprises Limited to overcome existing challenges and attain sustainable growth in the competitive coffee industry. With a strong emphasis on adaptability and innovation, Coffee Day Enterprises Limited can secure its long-term viability and prosperity in the coffee industry. Want to know the financial health of Coffee Day Enterprises Limited? We're about to delve into a detailed financial analysis report, evaluating key indices and ratios that provide insights into the company's valuation, profitability, growth, stability, and historical trends. Stay tuned to get a comprehensive assessment of the company's financial health. First, let's dive into the valuation of Coffee Day Enterprises Limited. The TSR value index sits at 18.06%, signaling an undervaluation. Similarly, the price-to-book ratio is 0.269, also indicating undervaluation. The book value trend, however, has been on a downward trajectory for the last 3 years. This suggests that the company is currently undervalued. Now, how profitable is Coffee Day Enterprises Limited? The TSR profit index sits at a disappointing 5% with no dividends to speak of. The net profit trend has been negative for 2 years running. Net margin, ROE, and ROA have all underperformed. Unfortunately, the company's profitability seems to be on the lower side. Let's move on to the company's growth. The TSR growth index is at a poor score of 19.18%. Despite notable year-on-year growth in net sales and net margin and a positive quarterly sales trend, the decrease in total assets over the past 3 years is a concern. The company's growth appears to be poor, with total assets decreasing over the past 3 years. Next, we'll look at the stability of Coffee Day Enterprises Limited. The TSR Stability Index stands at a poor 34.38%. The Altman Z-score at 1.25 suggests high risk. The company's stability seems to be at risk, as suggested by the Altman Z-score. Finally, let's examine the company's historical trends. Over the last 5 years, we've seen considerable volatility in Coffee Day Enterprises' financial ratios. The valuation ratios, such as the price, earnings, and price-sales ratio, have varied significantly. Similarly, the profitability ratios, including the return on capital employed and net margin, have shown considerable fluctuations. The efficiency and solvency ratios also followed this trend, reflecting the company's unstable financial health. The company's historical fluctuations in key financial ratios suggest significant challenges. To sum up, Coffee Day Enterprises Limited appears undervalued, but faces challenges in profitability and stability. Historical trends also show significant fluctuations in key financial ratios. It is advisable to conduct a more detailed analysis and consider current market conditions before making any investment decisions. Ever pondered the risks in investing in a company like Coffee Day Enterprises Limited with potentially shaky financials? Well, today we're diving into the intriguing world of financial risk assessment, using Coffee Day Enterprises Limited as our case study. Coffee Day Enterprises Limited brews an interesting tale of financial risks and challenges. Over the past couple of years, the company has been operating in the red with a negative net profit. Couple this with a declining book value and poor returns on equity and assets, and you've got a recipe for financial instability. This could adversely affect the company's financial health and long-term sustainability. Now, let's talk about market risk. Despite a remarkable leap in net sales and a significant rise in net margin, the company's total shareholder return growth index score is less than stellar. This suggests that the company's growth might not be sustainable. Furthermore, a decreasing trend in the company's total assets over the last 3 years could signal potential challenges in capturing market opportunities. Profitability risk is another factor to consider. The consistently negative net profit margin and a low total shareholder return profit index score indicate potential struggles in generating profits and maintaining profitability. Inconsistent operating and EBITDA margins further point to potential challenges in managing operating costs and expenses effectively. Solvency risk is another concern. With a fluctuating debt-to-equity ratio and an unstable Altman Z-score, the company might face difficulties in managing its debt and financial obligations. A negative interest coverage ratio also suggests potential difficulties in meeting interest payments, leading to further financial strain. Competition is fierce in the coffee market. Without a clear competitive advantage, Coffee Day Enterprises Limited may struggle to maintain its position and sustain growth amidst aggressive competition. Operational risk is another stumbling block. The fluctuating operating cycle ratio and inventory turnover ratio suggest potential inefficiencies in managing inventory and operational processes. These inefficiencies can lead to increased operational costs and reduced overall profitability. Finally, there's market perception risk. The company's historical valuation ratios have shown significant fluctuations, indicating that investors might perceive the company's stock as highly volatile and risky. This perception could impact the stock price and investor confidence, further complicating the company's financial position. So, what's the takeaway from the story of Coffee Day Enterprises Limited? It's simple. Risk assessment is crucial before investing. Consider the financial risks, market risks, profitability risks, solvency risks, competitive risks, operational risks, and market perception risks. Diversification and a thorough understanding of the company's industry and market dynamics are key to managing and mitigating potential risks. Remember, a well-informed investor is a successful investor.
Is the current model of capitalism leading us down a path of unsustainable growth and financial ruin? It's a question that has been echoing in the chambers of our global economy. We're living in an era where opening 20,000 loss-making restaurants adds more value than consolidating 1,000 profitable ones. It's a trend that prioritizes aggressive expansion and speculative valuation over substantial, sustainable profit. A trend that overlooks the old, perhaps wiser ways of doing business. Enter Mrs. Hegde, a woman who dared to swim against the tide. Mrs. Hegde, a businesswoman with a vision, decided to revert to the original and old model of capitalism. In a world where expansion often trumps profitability, she chose to swim against the current. Mrs. Hegde set out on a journey, consolidating her profitable assets and disposing of those that bled red ink. She took a leaf out of the book of the 50s where profits made more sense than speculative valuations and irrational expansions. She met her creditors, promising them full repayment over time, instead of a measly 5 pays on the rupee. The creditors, in a stroke of luck, agreed. Next, she decided to trim the fat. She promptly cut off all the unprofitable outlets, a step her husband had shied away from due to fear of losing face. She shifted her focus to properties owned or leased by CCD, rather than those merely licensed to them. She then decided to leverage her coffee plantations, raising debt against these assets and exporting Arabica coffee beans. She steered clear of risky ventures, preferring a steady 13% rate of return in her business over a greedy and uncertain 30% in wildcat schemes. In a world where expectations were low, she had a free hand and the support of excellent financial advisors. Mrs. Hegde's sage decisions started to turn the tide. Mrs. Hegde's old-school approach bore fruit, but she's not out of the woods yet. The overall debt has seen a dramatic reduction, from a staggering 7,985 crore to a more manageable 1,944 crore. This reduction is largely attributed to the smart moves made by Mrs. Hegde. She raised fresh debt against her coffee plantations and sold off core assets, thereby generating much-needed capital. However, the journey is far from over. Café Coffee Day still needs to tighten its belt further. By December 2023, the company must close down at least 190 more outlets. This consolidation will help to streamline operations and ensure the business remains profitable and sustainable. Mrs. Hegde's journey serves as a stark reminder that sometimes, going back to the basics can be the most innovative approach of all. After all, the old ways of doing business had a certain wisdom that today's reckless expansions often lack.
A lot can happen over Café Café Coffee Day.